Hello everyone. In the last two episodes of this ETF Digest series, we looked at what ETFs are and the key value proposition they present to investors. However, today we'll be discussing the other benefits of ETF to investors like you and I, as well as steps to purchasing an exchange-traded fund. But first thing first, let's go through the easy steps to investing in an exchange-traded fund. The first step has to do with open a brokerage account. As a new investor, to purchase units of ETFs, you will need to open as well as fund a brokerage account with a broker such as Vetiva. You can always reach out to sales@vetiva.com for more information on how to get started. The second step has to do with placing an order. Once your brokerage account is opened and funded, as an investor, you can place an order to buy shares of the exchange-traded fund of your choice. And this can always be done through the brokerage trading platform, such as the Vetiva online platform. The third step has to do with monitoring your investment. As an investor, you can monitor the performance of the exchange-traded fund that you are invested in and the overall performance of your portfolio on a regular basis. Now let's move on to other benefits of investing in an ETF. The first one has to do with diversification. If we recall the cocktail example in our first episode, diversification simply means with an ETF, you have exposure to the whole market or market segment or even an asset class like equities, fixed income, by simply investing in a single security. And the benefit of this is that the risk of investing in the individual components of the market or asset class are reduced because you are invested in a single security that houses different stocks. The second benefit has to do with portfolio performance measurement. ETFs provides you with a benchmark for tracking the performance of your portfolio. You're able to easily attribute which asset class or sector delivers the highest performance impact to your portfolio and be well positioned for possible opportunities in that sector. The third benefit has to do with transparency. ETFs offer higher degree of transparency as the index or commodity being tracked is typically publicly available. With this, investors can therefore easily tell what the constituents of a particular ETF will be and also understand what assets that they are investing in. The next benefit has to do with the cash flow benefits. ETFs always pay distribution. Distribution is like an income that you get for owning a unit of the ETF. For example, the VG30 ETF is structured to pay distribution twice a year. And with the distribution being paid twice a year, it means you have more funds available for you. The next benefit has to do with lower management fees. Due to ETFs being passive in nature, they tend to have a low fee structure than actively managed funds. Ordinarily, the management fee on mutual funds could range between 1% to 1.5% or more. But because of the passive management of ETFs, we can see ETF management fee ranging between 0.2 to 0.8% thereabouts. As such, all things being equal, this leaves more on the table for you and I with respect to distribution because it means the fund manager can distribute more income if they choose to. The next benefit has to do with convenience or accessibility as well as ease. Because ETFs can be purchased through a brokerage account and it trades like a share on the exchange, this makes ETFs accessible to individual investors with any budget. I hope you found this insightful. Please feel free to let me know your learning points from today's session. Thank you.